You're watching Sky News. Gareth Barlow with you. We're keeping a close eye on the Bank of England. The latest cut or change or rise to interest rates expected very shortly. We're expecting a cut that's widely being predicted by analysts and market watchers across the city. Current rate at 4.25%. It's expected to be reduced by 0.25% to 4%. That would be in line with what the markets are expecting. We've seen these 0.25% drops. Just hearing it is a cut to 4%. Interest rates cut to 4%. So that 0.25% fall that we were expecting, the Bank of England has just announced that. So a 4% interest rate has been announced by that Monetary Policy Committee. It's what was expected. We can tell you that our correspondent Gurpreet Narwan is in what is a lock-in down in the basement of the Bank of England, and that's where the Monetary Policy Committee, headed up by the Governor of the Bank of England, Andrew Bailey, explain their reasoning and their rationale to financial journalists. They are then let out, and we'll hear from Gurpreet as soon as we possibly can. But a lot of the time we've been talking about reducing interest rates or changing interest rates. That's been in reaction to inflation. Well, consumer inflation is currently, the Consumer Prices Index is currently at 3.6. Now, that's above the bank's target of 2%, but it's not inflation that's really the key driver at the moment. The thinking is, yes, inflation is too high, but it's actually a weakening labour market and a weakening wider economy that means that there's no upward pressure on price growth. And that's kind of encouraging the bank to make these changes. It will also have seen a slowing in the pace of wage rises as well, and will be concerned about a slight increase as well in jobless rates as well, which have been reported in recent months. So like I say, interest rates, the bank's base rate was at 4.25%. It's dropped to 4%. Just to remind you as well, these kind of stories bring about a lot of questions. Scan that big old QR code on your screen right now. We're going to take it through to the Money blog. It will bring you all of your questions. You can submit them there. We'll then bring you all the answers at 2:30. We've got a Q&A panel. It's going to tell you what the interest rate cut means for you, your mortgage, your wallet, and also the UK economy. And can also tell you that later we're going to hear from the Governor of the Bank of England, Andrew Bailey. Like I say, with mortgage rates, it's often the case that banks predict these rate cuts so widely ahead of time that actually they factor in these cuts ahead of time into their mortgage rates. So when you look at the high street banks and what they're offering, they've often taken in the predicted cut into account. So you often don't see major changes to mortgages straight away. It may be not until the next Monetary Policy Committee upcoming that banks start to reimagine or realign their interest rates. So we'll keep a close eye on that. I can also tell you that there's plenty more insight and analysis being pulled together on the Money blog, on the live page, on the Sky News website. And I can tell you that it voted, the Bank of England, to bring interest rates to the lowest level in more than 2 years. It voted to reduce the rate from 4.25 to 4%. That's a level we've not seen actually since March 2023. And like I say, it had widely been predicted by financial markets. It's the third rate cut this year, the fifth since last August. One of the other key things to watch on this is how the Monetary Policy Committee voted and what the split there is. 9 voting members, and it's often interesting to see if there's any dissenting voices and what their reasons for dissent were. But we can tell you that they did vote to bring about that cut. And the rate plays a huge role. It helps influence the rates offered by banks and lenders on products, anything from a savings account to a credit card to a mortgage. Borrowers, of course, will be pleased to see that cut. It means that the rate you're going to be charged on your debts could go down. It might not. But if you're a saver, it's not such positive news. It means that you may earn less on your savings. I can tell you, actually, a little bit of movement on the pound against the dollar. Let's just bring you that. The pound has risen versus the euro as well. And the pound has also risen against the dollar. And the UK's two-year gilt yield has currently just inched up ever so slightly as well. Let's bring in Andrew Sentance, former member of the Monetary Policy Committee. Good to have you with us. Your reaction to what we've just heard?
Well, I didn't think that the interest rate cut that the MPC has made was justified. And the reason for that is that inflation is going up and is not clearly going to come down to the 2% target. So they've already cut interest rates 4 times, and therefore they're going too fast on cutting interest rates. But now they've made this cut, I'm hoping that they won't make further cuts, because that's not going to be justified until we see inflation coming down. The most likely scenario, however, for inflation is it's going to go up to over 4%. I don't know what the bank said in its forecast today, but over 4% in the autumn. And it's going to take some time to come down to 2% if it gets there at all.
That 2% figure, I'm just thinking we've not been at 2% for quite some time now. Is it still an appropriate target for the bank to be measuring against?
Well, it's a target that's being used in many other countries, and we've used it, or some version of it, since 1997 when the MPC was established, which was over 25 years ago. The way I describe it is it's inflation that's so low that it's not really noticeable. If you start getting up into figures like 4 to 5%, which we have been quite recently, people notice that their cost of living is rising, and so they don't regard that as low inflation. So about 2% is really around about the figure which allows people to believe that prices are stable.
Andrew Griffith for the Conservatives on comment earlier today saying that this cut, if it was to come about, which it has, is a sign of weakness, not of strength. Is that what you would agree with, considering the fact that we're seeing these challenges for wage growth and increase also in the joblessness rate as well?
Well, the MPC is certainly responding to signs of economic weakness in terms of both GDP growth and in terms of the jobs market. I think the question for economic policy is whether that is the right thing to do now when inflation is still so high. Their primary objective is to combat inflation. But the fact that inflation is high is also a sign of economic weakness. So there is some strength in those criticisms that actually interest rates are being cut, not because the economy is doing well, but because it's not doing very well at all.
We always talk about what this means for savers and for borrowers. It's fair to say, is it not, that a lot of the banks predict these changes so widely that they will have already made their changes to high street products, and that actually, people with mortgages shouldn't all of a sudden expect to see a big tumble as a result of this. It's probably already been factored into what they were being offered in previous weeks.
That's certainly correct. The mortgage market hinges very much on the 2-year outlook for interest rates. And because this reduction in interest rates was widely anticipated, I don't think it's going to change mortgage prices very much. It's not going to feed through very much into the cost of borrowing for people with ordinary mortgages. But the impact that lower interest rates has on the economy is very complex and goes well beyond the impact on mortgages. So there are all sorts of other factors that the MPC has to take into account when it's cutting interest rates.
MPC, independent of the government of the day, but the impacts and the decisions of the MPC will have an impact on the government of the day. And there was only a report yesterday by one think tank that suggested the Chancellor, Rachel Reeves, would have a somewhere around £41 billion shortfall to try and make up in the autumn statement in the budget that's coming in a matter of weeks. What would this mean for the Chancellor? What would she take away from this? And what might the government response be in due course?
Well, the Chancellor will probably put a positive gloss on the fact that the bank has cut interest rates and show that it reflects confidence in her economic policy, but I'm not sure that's going to be quite right. As the National Institute pointed out yesterday, we're heading for a deficit of 40 to 50 billion pounds on the measure that the government puts the most focus on. And so that deficit is something that the Chancellor is going to have to address in some way, either by reining back on public spending, which has gone up an awful lot over the last year or so, or through tax increases.
Joining us live here on Sky News, Andrew Sentence, a former external member of the Monetary Policy Committee of the Bank of England. Appreciated, thank you. And just a little bit of extra information, I can also tell you that consumer prices index inflation, we were just talking about that with Andrew there, forecast to peak at 4% in September, up from a previous 3.5%, set to be higher than previously thought over the next 2 years as well. That's further information from the Bank of England. I can also tell you that the Chancellor is responding. Rachel Reeves saying this fifth interest rate cut since the election is welcome news, helping bring down the cost of mortgages and loans for families and businesses. The stability the government, as she's referring to there, have brought to public finances through our plan for change has helped make this possible and helped us become the fastest growing economy in the G7 in the first quarter of this year. We're locking in this growth in the long run by investing £113 billion in infrastructure, securing 3 major trade deals and embracing the technologies of the future to drive up wages and improve living standards across the UK. Response there from the Chancellor. Well, let's bring in our business and economics correspondent, Gurpreet Narwan, who joins us live now. And Gurpreet, we just heard there from Andrew Sentence, who said, look, the Chancellor's going to put a positive spin on it, but there are underlying deep issues that the Bank of England was most likely responding to.
Yeah, and I think food price inflation is one of those. I'll get into that in a minute because it was one of the more interesting aspects that came out of the monetary policy report, which the bank publishes alongside its rate decision. But firstly, I'll just run through the headlines for those who are just joining us. The Bank of England has cut interest rates for the 5th time in a year. So for the 5th time since it began cutting rates in August last year, taking the base rate from 4.25% to 4%. Now, that was a widely expected move, but financial markets had almost 100% priced in the fact that the bank was going to cut the base rate to 4%. But what is really interesting is the policy rift that's emerging on the bank. Well, that has been emerging for a while now, but it was really thrown into sharp relief today because the bank had to vote twice for the first time ever to reach its decision. 4 members of the committee wanted to cut. There are 9 members of the committee, by the way. 4 wanted to cut by 0.25 percentage point. Another 4 didn't want to cut at all. And then 1 member, Alan Taylor, wanted a bigger cut of 0.5 percentage point. In the end, he joined the 0.25 percentage point camp to get a rate cut across the line. But it just shows you how challenging it is for policymakers to navigate the current economic climate, how challenging it is to calibrate the correct policy response. Because on the one hand, you've got the economy stagnating, although the bank today did say that there's a bit of greater clarity now on the back of some of the trade deals that Donald Trump has signed. So some of that tariff uncertainty has receded. But unemployment is also rising. Since the Chancellor's national insurance contribution increases have come into force over the past 5 months, we've seen the number of payrolled employees drop. And actually, 1 member, Alan Taylor, the one who voted for a bigger cut, said he was worried about a recession as well. So there are some of the kind of growth side fears that are weighing on policymakers. But then at the other side of all of this is inflation. Now, the bank today upgraded its inflation forecast. It said that inflation would peak at 4% in September. That was up from a previous estimate of 3.75%. Now, it pointed to a range of explanations. It talks about utility bills going up. We know that council tax is going up. We know that water bills have been going up. But it also talked about food, and food is playing a big role here. It said that food price inflation could hit 5.5% later this year. Then it would drag the overall inflation rate higher. And bearing in mind that about 11% of what households consume goes on food, it means that it could play an outsized impact on our perceptions of how high inflation is. That means people will go back to their employers, ask for greater pay rises, and that could create something called second-round effects, causing inflation to climb even higher. Now, in explaining why food prices are going up, and this probably isn't news to people who have done a supermarket shop recently, the bank said that, well, part of it is what's going on in the climate, poor harvests, bad weather. There are also some changes in packaging regulations which are pushing food prices higher. But a big one is also employment costs, increases in national insurance contributions, increases in the national minimum wage, which are affecting food retailers and employers. And so while the bank doesn't like to get too political, likes to keep its language neutral, this won't be good news for Rachel Reeves.
Gurpreet, joining us live from the city. Thank you so much. Just a reminder that breaking news this hour, the bank's rate has been cut to 4%, down from 4.25%, widely expected. But if you scan the QR code appearing on your screen right now, you can take yourselves through to our Money blog. You can submit your questions for a live Q&A panel on what that interest rate cut means for you, your mortgage, your wallet and the UK economy. The answers to come at 2:30 this afternoon.